What's up, everyone? Welcome to the daily macro update for Thursday, August 14th. Taking a look at the numbers that we got this morning for producer prices. That did have a fairly large acceleration if you were only paying attention to the headline number. But as you know, you have to dive into the details in order to actually see what matters, because there's just too many people who just, look at the headline and run with it. But we want to make sure that we are understanding the context of data. You never just want to look at data on the surface and be like, okay, because of this, then this. No, you always have to look at the context in which data is, being produced, right? All right, so let's go ahead and dive into it here. Really, the main thing that I saw in this report was that over 75% of the entire acceleration was due to final demand services. And so if we take a look at that chart right here, we can see that it did have a decent 1 month acceleration from 2.7% to 4%. And so the only thing is that when you dive in further into those numbers, right? So when you look at trade services, that had a large acceleration. But when you look at final demand services, less trade services, that actually continued. It did have a slight acceleration, but is still, around, very low levels that were around 2023 in May, right? So let me move up the chart here a little bit. So in terms of producer prices, which again, this is the prices or the inflation that businesses receive for what they sell. It's not the same as consumer inflation, all right? So, when it translates to the actual consumer prices that you and I face, these are a lot different. If you start to see inflation rise while producer prices are rising, well, that's obviously, a sign that these producers are pushing a lot of those costs onto us, which kind of what it looks like is happening. But yeah, CPI is all about, the prices that you pay at the checkout line, and PPI is all about the pipeline inflation that producers are paying. All right. So it's a little bit different. PPI can a lot of the time front run CPI, but what's interesting is that when you take a look at some of the other components that have to do with trade, right? So this is trade of finished goods that had a large acceleration. Trade of personal consumption that had a large acceleration. Trade of private capital, look at that. That's the highest that it's been, since October, or actually, September of 2022. So what this is really telling the market is that producers are 100% seeing inflation from tariffs, right? I mean, just look at this 1 month acceleration from business equipment. That went from 5.8% year over year up to 14.5% year over year. So that's massive. What this could tell us is that in the coming months, we could have even further upward pressure on inflation. It doesn't translate directly, right? So just because you saw a large acceleration here doesn't totally mean that, CPI and PCE are going to rise at a similar level, because there is a lag effect here. But really, the main thing that contributes to PCE that I always look at, my team looks at when it comes to the producer price index, is this one right here, which is core producer prices minus the trade services, right? So you want to exclude imports and exports. You want to exclude volatile items like food and energy, and that gives you a more accurate version of things that have more of a potential to pass through to the CPI report as well as the PCE report. And as you can see there, that had a slight acceleration from 2.5% to 2.8%. So that is a noticeable acceleration, and definitely isn't a continuation of the 3 months of deceleration that it has been doing since March of this year, right? So it did stop that trend, but it still is remaining lower, and so that's partly why when you take a look at the target rate probabilities for the September Fed meeting, you still have an overwhelming majority of a stance that the Fed will cut by 25 basis points. Now, it's a little bit different from yesterday. This time yesterday, there was actually a little bit of a chance. It was very small. It was like less than 1% that they were going to cut by 50 basis points, but that changed after the PPI report today. And so when it comes to the Fed rate cuts, what's most likely going to happen here is that, yes, they cut by 25 basis points, but then they halt it again, just like last September, right? They cut by 50, they paused, and then they cut a little bit more, right? And so that's probably what they're going to continue to do, right? We may not get a rate cut in November unless things really start to fall out of place. What I don't hear too many people talking about, though, is that in a couple weeks, the Fed is going to gather in Jackson Hole, Wyoming, for their annual Jackson Hole Symposium. And so with this, the Fed chair, Jerome Powell, typically gets on TV and does some type of speech where, in the last few years at least, he has used this Jackson Hole Symposium as a way to almost have a little bit of a precursor to the September Fed meeting. And so all eyes will be on that, I believe. Let me see here when that speech will be. That'll actually be next Friday, August 22nd. So make sure you guys are marking that on your calendar. I'll probably go live for that to do a live analysis and market reaction for that. So I know that we switched to Monday through Thursday, but I'll do a special one next week on Friday for the Jackson Hole speech. But just keep that in mind and on your calendar there. Going back to the PPI number here, it was mainly just a large portion of that final demand services, and then you also had a large portion being from dry vegetables and meat, which that's something that a lot of us pay for, and I'm sure you guys have seen at the grocery store how those items have definitely gone up, some by like 50%, right? Especially, I don't know if you guys if there's anyone who's listening right now who's from South Florida or, Florida, Georgia, kind of like very, southeast United States. We're at Publix, which is the grocery store by us. Publix has just gotten out of control. In fact, when it comes to meats, I actually find better deals at, either local like butchers around me, or I'll go to like some type of farmer's market, and they actually have way better deals on meat. And it's like, I just want to not have to pay a 50% increase every single year for, stuff that I like to eat. But the stuff that you and I pay for are going to continue to experience some accelerations here. And the Fed has a very difficult decision because they're kind of damned if they do, damned if they don't. If they don't cut interest rates, obviously, Trump might fire Powell at that point. I don't know how he does that because he can't necessarily by law. They'll probably reintroduce or reinvestigate all the stuff that's happening with the Fed building, which is just an excuse to get Jerome Powell fired and kind of give like some pressure on him, which is really like a mafia bully tactic by Trump, and really just not what you want to see in terms of like this fiscal dominance that you're seeing right now, right? Once you get into a time where the government is bullying around the central bank to do what it wants, instead of the central bank being independent and acting based off of what the data is seeing, that's where civilizations pretty much go off the rails, right? I mean, just go ahead and study and read the book, The Fourth Turning by Neil Howe, and you'll see, he covers that. As soon as the government is dictating where interest rates are, well, guess what they're going to do? They're going to make it positioned to where they can just borrow as much money. And the consequences, even though there hasn't really been any consequences, there'll even be less of a, pressure on them to not spend as much. So, like, if you think their spending is bad right now, just wait until Trump gets what he wants and we go into a very strict fiscal dominance type of environment. And that's where we're headed, unfortunately. Can't really control that. The only thing that we can control are the things that you and I invest our money in. And a lot of people, especially, some people in the country who think like investing in the stock market, there's like zero sum game and that it's evil and for evil people. Well, the thing is that one, in nature, it's a zero sum game, right? Energy can't be created or destroyed. And so with the markets, yes, there is a buyer for every seller, but you have to use what's going on right now, not as a way to try and just sell for someone else who's buying it. You have to think about it as, I need to preserve my purchasing power for my family because the out of control central bankers and the out of control government is just going to keep devaluing my purchasing power, and it's going to get worse and worse, excuse me. And so think of investing in the markets as just protecting your family and your purchasing power, which is really what it is, right? You're just maintaining your dollar's power over time by investing in the market. And by that logic too, it's like, even when you're buying and selling real estate, there's still a buyer and a seller. So I'm not sure what the logic is for people who are like thinking that the stock market or buying Bitcoin is evil or anything like that when they're okay with buying illiquid assets. But anyway, getting into the market here, taking a look at the S&P 500, it did have a little bit of a dip early on. Hopefully you guys were buying some at the beginning of the day there. And yeah, I mean, it's continuing to push up to our top end of the trading range. And now you get to sell some a little bit. There have been plenty of assets that were having a dip here this morning that are in clear bullish trends that are now having a nice little pop towards the end of the day here. It looks like we're going to have another fantastic week with the markets moving higher. When we take a look at volume still continues to decelerate though. So, I mean, you're still seeing that bearish divergence with volume. So let me just take these two indicators out and leave the one below this. So this indicator that we created below here, the green is the 1 week average volume, and the blue is the 1 month average volume. And so typically when the green line gets below the blue line, that's typically a, when volume is decelerating. And so you use that and look at the price charts to see what that actually means, what type of divergence that is. And so seeing how prices are going up on decelerating volume, by definition, that's a bearish divergence. And so what that means is that, you want to make sure that you're taking profits when necessary. And when I say take profits, I don't mean, just sell everything and go all into cash. A lot of people who think like trading or investing is just so binary where you're like all in or all out. That's not it at all, right? Things can be incremental, meaning you can still be bullish on something, but if it gets overextended by, a couple standard deviations, take some off the top. Not only does that pay yourself, right? But it also allows you to risk manage, because if it goes down or breaks trend, well, you've taken profits and so you're good to go. But if it still maintains a bullish trend and you've taken profits at the top and now it has a decent correction, once volume comes back, well, guess what? Now you have money to put back in and start to actually compound your wealth in a way that's also risk averse. Those are the things that we talk about in our macro investing community. And you guys should think about it that way. It's not a gambling. It's all about probabilities, right? All these different skills you have to learn. It's just like, any type of sport or anything that you do. But there is a way to do this to where it's stress-free and you can just keep compounding your wealth over time. You don't have to be binary. Be incremental. All right. Let's see here. Going into, let me see what the updated Cleveland Fed stats are here. Okay, so what's interesting is that the core PCE estimates have not changed. That has it continue going up, which again, we're going to be getting, actually, I think the core PCE in August comes out after the September Fed meeting. So that'll be very interesting if we get an actual accelerating core PCE number on top of the Fed cutting rates. That would be something that the market will probably not like, because it's clear that any type of signal that the market gets that inflation is accelerating, well, guess what? That's going to keep rates higher. A lot of people think that if the Fed cuts rates, that means that 30-year fixed mortgage rates or credit card rates are also going to come down. That couldn't be further from the truth. If you want to know what your credit card rate, or if you want to, sell your house so that you can buy something that's not at 7% mortgage rates or 6%, you have to pay attention to the 10-year U.S. government bond yield, which remains in our stagflationary ping pong ranges here, right? So between 4.5 and 4.2%, it's pretty much been stuck here. And obviously, you've had periods of time where it deviates from this, but for the most part, it's been within this range. And, this is something, if you zoom all the way out here, these are rates that are much, much higher than, from what we've seen before. Let me actually go out on the weekly time frame just to show you. So this is going all the way back to 1992 here, right? And so if this doesn't actually come down, that means that 30-year fixed mortgage rates are going to have trouble coming down. That's going to mean that your credit card APY is going to have trouble coming down. Car loans as well. Basically anything that you and I transact with on a consumer level, 10-year U.S. government bond yield. And, why do we even say that? Well, let's just go back to when the Fed cut rates, right? All the way back in September of last year. What did interest rates do when the Fed cut by 50 basis points exactly 1 year ago? Put that in the comments below. Interest rates went up, right? We'll go ahead and we will put the Fed funds rate below here. So let me make this a better color just so that you can see it. Let's go with yellow for the Fed funds. All right, let's make it thick. All right, so yeah, let me get rid of these. Let me see if you guys can see this okay on the chart here. Let me move my face. There we go. All right, so just zooming in here, remember when Fed funds was at 5%? And they cut 3 times? Well, what happened to interest rates as they cut 3 times? They went up. So again, for the people who are cheering on rate cuts, just know that there's no guarantee that also the rates that you and I pay also come down. And we have just 1 year ago recent evidence that suggests that if the Fed gets their policy decision wrong, which is what the inflation metrics are showing that they're about to do, they're going to keep cutting rates and interest rates are going to continue going up. I know that sounds confusing. They're going to lower their effective federal funds rate, which, you and I don't pay the Fed funds rate. The Fed funds rate is for mainly the government as well as other commercial financial institutions. We don't pay that rate. They get a special rate. So unless you want to become a bank, you and I are going to be paying what's going to be reflected in the 10-year U.S. government bond yield. And so again, if they get the policy rate wrong, the Fed is going to cut rates like your little heart desired, but then yields are going to, bond yields, the bond market is going to reject that and continue higher if we stay where we're at. And yes, I mean, a lot of people don't think about this. I know some of you do, and I appreciate that. We have some good discussions in my DMs on Instagram and on TikTok. So yeah, always got to keep that in mind. Always got to keep that in mind there. VIX still remaining super low, and I say all that to say that I'm not going bearish on the market, by the way. Right? Just because the Fed gets their policy rate or the policy wrong, it doesn't mean that the market's going to tank. In fact, we saw the opposite. Let me go back to the 10-year here. Let me zoom out a little bit. Let's put back the Fed funds rate. Let me put that in yellow again. I haven't brought this up, so I will be seeing this for the first time like you. But let's bring up the S&P 500. All right, so the S&P is in purple there. Isn't that interesting? So when the Fed cut rates, the market just continued going up with yields, because if the 10-year is going up, that's a signal that you could have inflation as well as growth accelerating, right? And then, what happened right here, where the 10-year U.S. government bond yield actually went bearish pretty much an entire month before the S&P 500 went bearish, which is interesting. There was a positive correlation there, which is why correlations matter, and you have to track correlations. Again, this yellow line is the Fed funds rate. Purple is S&P. The candles here are the 10-year U.S. government bond yield. But something happened recently. What do you notice? What happened in June? There's been a divergence here. So you have the market continuing to go higher while the 10-year U.S. government bond yield goes bearish. So what happened there? The correlation flipped from positive correlations to negative correlations. And so if you're not tracking when things maintain bullish trend, lose bullish trend, as well as maintain or lose correlation, positive or negative correlation, then you have to level up your game. Now, seeing that this happened here, the market is taking that as, hey, it looks like inflation might be a little bit out of control here, right? So that's the market reaction that we're seeing. But now, because they're oppositely correlated, what do you think will happen to the market if you start to see a surge in the 10-year U.S. government bond yield because it's reacting to the Fed getting the wrong policy? You'll probably see a correction in the S&P. All right, so you're seeing how all of this kind of leads up to the September decision. And what you need to be paying attention to is the reaction function by the bond market, because the 10-year U.S. government bond yield is not controlled by anybody, right? So the 2-year, the further the shorter you go on the yield curve, the shorter duration you go on the yield curve, the more heavily it's influenced by Fed rate decisions. The longer you go, the more it's influenced by growth and inflation expectations. All right, we hammered that. Let's see what else here. A little bit of a pop in oil, but oil still remains in bearish trend. Gold didn't like that jump in rates here, still kind of pushing sideways from where it was back in April. Gold has lost a lot of trend strength, but what hasn't is gold miners and junior gold miners. Those still look pretty good there. Bitcoin having a little bit of a correction today, but still maintaining its bullish trend here. I was buying a little bit of Bitcoin. Let's bring up the ranges here. So this is why it's so important to have a tool like these trading ranges, because look, it went right up to the trading range zone, selling a little bit there, just a little bit though, just some, no stress. And then guess what? Now it's coming back down to the low end of the range here, and I can buy it back. Doesn't matter if you're a long-term investor just trying to manage risk. Doesn't matter if you're a day trader or a leverage trader just trying to take advantage of 24-hour moves. Ranges help. And if you guys would like these, just go to our website and you can find out more information about our partnership circle. So yeah, pretty standard stuff there with that move in Bitcoin. We were also acknowledging that, on this move here that Bitcoin was doing, similar to what we saw in the SPY. Well, what has volume been doing since it had a bounce here on August 2nd? Volume's been decelerating. And now on this move here, you're having a little bit of a spike in volume. So again, you notice that bearish divergence, and you're able to execute once something in bullish trend gets to the top end of the trading range. It's one thing to know all this data, but it's another thing entirely in order to have the process, in order to execute on all this great information, because otherwise you're just going to get saturated with a bunch of stuff and you're going to have analysis paralysis. I know I'm speaking to someone out there because I used to experience that as well. Let's see, the market closed here. What are things doing after hours? A little bit of a taper off here after hours. Nothing too crazy, but yeah. The mega caps remain in bullish trend. Nothing nothing too crazy here. Let me see what China's doing actually. China is in a major bull market right now. My preferred China exposure ETF is KBA. That thing has been pretty solid. You can use GXC as well, or EWH. You know, pretty much all three of those work well if you want some China exposure, and you are US based. Let's see. Eurozone, it's testing all-time highs again. I think the most bullish one, though, is Greece. The ticker GREK is Greece exposure. I mean, that thing is just, look at this. Look at Greece. People are saying that they're happy about their returns with the S&P 500, but since 2025, the Greece ETF, GREK, just this year is up 72%. Wow. This is why macro is so important, because it points you in the direction of these types of these assets that are, you know, giving you better exposure. If you guys knew that Greece was having a major bull market, let me know in the comments. But this one has been absolutely incredible to have to own this year, and it just looks like it's not even stopping. Am I buying it here? No, don't chase things at the top end of the trading range. All right, let's go to some comments here. It's 4:12. We'll open it up. How's everyone doing? Buying some altcoins on this dip? Yeah, I was buying some, select few. We have an entire list that we give to our partnership circle members. We give signals on like the top 10 coins. And then we have our top 10 selection as well, right? I don't know about you, but if I have more than 10 altcoins in my portfolio, I'm not keeping track of those things. I'm simple. I can't have more than 10. Otherwise, I just get overwhelmed and I make mistakes. It's kind of like, you know, if you're playing golf and you're trying to whack the heck out of it, it's probably going to go into the woods. But if you slow it down to maybe, you know, 70%, yeah, it's not going to go as far. But guess what? You're going to stay and play. All right. Let's see. Let's go to Instagram comments here. What's up, everyone? What was the book called again? Which book? What are you referring to? Oh, the book. The Fourth Turning is Here by Neil Howell. Maybe I can pull that up here. It's this one right here. If you guys have a flight coming up, man, this book, you know, download it on audio. Let me see. Will it come up? Yeah, here you go. You guys have probably heard about this book as well, but I 100% recommend. Yeah, he goes back in history to like the last like 1,000 years of civilizations, and he goes and overviews them with the patterns that they have. Very very interesting stuff. And yeah, I mean, Neil is a pretty smart dude, way smarter than me, but I definitely recommend this book here. Every civilization does this, from Romans all the way back to Babylonians. Yep, it's true. It's nothing. It's the human mega cycle, right? These are like 1,000-year cycles. Crypto buy opportunity today. Yep, trickle down economics is great. How do you position yourself for this Fed cut if continuing to go up DCA and assets, or wait for a dip then buy up? Danilo, that's a good question, but the thing is that I don't really care what the Fed does at the end of the day, right? Like I'm not going to make buying decisions based off of like what the Fed is doing. I always make my buying decisions based off of which current trend is happening the most or the strongest, right? Which ones are not, which assets have the best correlations, right? So it's not just that you should invest in things that are bullish. You have to find the best bullish ones, as well as ones that, might be different asset classes that might give you some diversification, but are still both in a bullish trend, right? That's key. But if things just keep going up, I just want to have exposure to those. And then when they go up to the top end of the trading range, you take some profits. Once they go lower, then you buy back again. And you just keep doing that rinse and repeat. Yield curve control. Yep. The Fed is definitely, or not the Fed, the government, Trump and his team are definitely doing like pseudo yield curve control. Janice asks, am I buying meme coins? No, I'm not. I don't buy meme coins. Those are essentially people who are trying to buy lottery tickets, and that's not what I do. I try and manage and preserve my purchasing power, not give myself too much of an exposure to where I could lose purchasing power even further than what inflation is already doing. What rate does the 10-year have to reach before you see a correction? I don't know. I mean, that's the decision for the market to make. All I know is that the 10-year U.S. government bond yield as well as the S&P 500 are currently negatively correlated. And so, yeah, we can even just go to that correlation right here. Right, so this is an indicator that our partners have, but just to showcase it here, you have these different macro points. You have it being versus the S&P 500. So these are all the rolling correlations. You have emerging markets, gold, oil, 10-year bond yield, commodities, dollar, and Bitcoin. Emerging markets and Bitcoin are the two most positively correlated. The two most negatively correlated are oil as well as the 10-year. So based on that, you can really position yourself in the right way. Again, if you want access to these types of indicators, then you can just go to our website and learn more about our partnership circle and book a time with me. All right. Good question, though. Good question. Do you use any Bayes theorem in your analysis? No, I don't know what that is, so I don't use it. Always open to learn more things, though. I'm always looking to improve, so maybe I'll look that up a little bit later. Thoughts on the recent U.S. Treasury auction, 10-year and 30-year? 10-year was pretty much fine. 30-year was fine too. But what was noticed is that, you're seeing a large pullback in foreign interest in longer duration government bonds. And because of that, I mean, why do you think the government, why do you think Treasury Secretary Scott Bessent announced that they're going to be ramping up their buyback program, meaning they are selling bills and they're using some of that cash in order to buy back their own longer term debt because demand for them is slipping, which puts a cap on yields, and effectively the government is doing their own version of yield curve control. So yeah, it wasn't a good option, or it wasn't a good auction for the 30-year. Thoughts on Hut 8 mining? Bullish. Just had a breakout. Don't buy it now. Not financial advice. Just telling you what our process is to do. Look, it went right to the low end of the trading range zone here. You had multiple times here early in August before this pump. That's why the ranges are so valuable. It tells you when to buy. Well, it doesn't tell you when to buy. It gives you a very nice probability zone. Aave is bearish. Got in at $21. It's pretty good. Glad you're up. Love hearing people make money. I love it. Scott Besson apparently plans to sell U.S. debt for stablecoins. Can this be positive for Bitcoin? I don't know how. A lot of people in the crypto space are celebrating this whole stablecoin thing when they're not even realizing that this is only because the government has no money and they're actually using that as another means, as a money market fund in order to funnel cash into it. Yeah, the government isn't pro crypto. It's pro stablecoin because of their own interests. Is the overall market bearish or bullish for the next 6 months? I don't know. I can't tell the future. But from looking at our signals right now, it looks like things are going to remain bullish. I don't know when things are going to go bearish, but they continue to be bullish. When people always ask me, when is this going to happen? Or at what price level do you think this is going to do? I always say, I don't know. I can't tell the future. But what our model is saying is that things are going to remain bullish for now. And when they turn bearish, then I'll be bearish on it. It's just like playing any type of sports, right? You're not thinking about what could happen on the next play. You're looking at what the other players are doing, reading and reacting, and using your own skills in order to react in the best way to give you an advantage to do defense as well as give you an opportunity to, go on the offense, right? Investing in the markets is just like playing sports. You're reading and reacting. You're being athletic. You are not trying to predict what the score is going to be at the end of the game because that's pointless. For fun, you can make a prediction if you want to be like confident or whatever, or try to, taunt your opponent. But really, it's really pointless to try and think in your mind like, oh, what are they going to do, right? You look for signals and tells, and then you react accordingly based on the best of your ability. Same thing. I'm going to continue being bullish on the market until it's no longer bullish in our model. Thoughts on quantum computing? Rigetti, yeah, there's a lot of different ones like that. I don't really have a fundamental base case for these quantum computer, tickers. What I do see is that it's in bullish trend in our model and it's at the top end of the trading range. And yeah, you just don't want to FOMO in right here, according to our model. You do whatever you want. But yeah. Just looking for opinions, not predictions. Yeah, I mean, my opinion is that I can't predict the future, but our model is still signaling that things, are going to remain bullish. So, do you agree with Scott Bessent on the Bank of Japan having to raise interest rates? If so, do you think it will have the same effect as the last time they raised rates? Possibly. Again, I can't predict the future, but yeah, I mean, the whole Japan carry trade thing is still a risk that's on the table. But again, I mean, I'm just gonna wait and react to when those things unfold. I'm not gonna make trading decisions based off of what could happen down the road, because you're gonna miss out on opportunities. All right, everyone. Well, I appreciate everyone for joining here today. We will not be going live tomorrow on Friday since we're only doing Monday through Thursdays from now on, except for next week. We're going to go live on Friday for the Jackson Hole Symposium speech. I believe that's in the morning too, so it'll be an earlier live stream on Friday next week. But we still have our Sunday macro wrap-up, so every single Sunday I get on this channel here, and we go live at 8 p.m. Eastern Time. That's 5 p.m. Pacific Time, and we just go over the macro highlights from the previous week, the macro highlights that I'm looking forward to, and kind of, a little bit of my positioning. And then we stream those for the first 30 minutes. And then the last 30 minutes of those, we go offline just for the people in our group who joined via Zoom. and then we answer questions and go over some tickers there. So if you guys want to join that, head to our website there. You can actually have access to our community for 7 days as a free trial. 7 days is plenty to know if, what we're going to do is going to be helpful for you. And if you love macro, love data, and you love to position yourself in the best way to win in the highest probabilities, it might be for you. If not, you can just cancel after the 7 days so that it doesn't charge you. No hard foul there. So, all right. Appreciate everyone for joining. Have a great rest of your day and weekend, and we will see you on Sunday. Bye, everyone.